Good morning, everybody. I think we are ready to go. So, as usual, the format is after the news first, and then we'll be talking to our guest, who's this week is David Smith of Henderson High Income. So, news-wise, I think the biggest thing is probably the merger of independent monks. So we'll cover that. I wanted to return to BioPharma Credit because that's we had them on the show recently, and there's a couple of things happened that I think just illustrate the story quite well. And then we'd have a quick look at Trian Investors, where there's been an EGM. So, Monks and Independent first. Independent's been around for 22 years now, almost. It's run by Max Ward. Basically, it's a bunch of ex-Bailey Gifford people who wanted to keep running the money their way. And they got Max to run it. They put their own money in. And so a lot of the directors actually have quite a lot of their own money invested in the fund. It's got £244 million market cap, and it was quite a sort of free-ranging brief. So basically, it was anything that Max fancied that he wanted to invest in, and it was kind of warning that you keep in for a bumpy ride because we're not going to promise you that we're trying to run this against any kind of risk-adjusted benchmark or anything else. There's the chart, and it has been quite bumpy, as you can see. It did particularly well into 2018, and then it's had more difficult times since. Well, as usual, investors loved it when it was soaring and were buying it on massive premium, and then saw that unwind again, and it's ended up now at a reasonable discount, or at least it was before the news was announced. There's the spike in price once this deal was announced. Monks has got a much longer history. It's now run, well, it's been run now for 7 years by Spencer Adair and Mark McColl, who are part of the global alpha team at Bailey Gifford. It's about 10 times the size of Independent. And it's another, as we know, it's another kind of growth focused fund, but a bit more, so let's say less gung-ho than Scottish Mortgage. So sort of kind of diversified range of growth stocks, as it says there. And there's its chart, which doesn't have the same kind of fall off in 2018, but does have a fall off more recently as the growth stocks have fallen out of favour. And again, since it's fallen out of favour, the discounts open up a bit. Now, normally, trying to combine two funds on discount would be problematic. But actually here, I think it's going to work. And this is a sort of template for other deals that could be done, I think. So the way that we do it, it's a legal thing called Section 110 of the Insolvency Act. What it does is it gets around triggering capital gains tax liability for investors in either fund, so particularly independent. So it's not a question of sort of liquidating independent capital gain and then rolling that money into Monks. It's done as this stream of destruction. And the way the combination is done is based on asset values. Well, in this case, it's formula asset values. So basically, the formula asset value is just the net asset value, but adjusted for the cost of doing this transaction. Really commendably, because I think this is quite important in these situations, there's a cash exit opportunity, and that is completely uncapped. It's not at asset value, but it's asset value is 2%, so it's pretty close to the NAV and a long way north of where the shares were trading ahead of this announcement. Because though it's a 2% discount, that means that any shares that go out that way end up increasing the NAV for those people that are still left in. And that will benefit the ongoing rolling shareholders. It needs approval by sets of shareholders, but crucially, the independent directors, who are at about 24%, will roll their shares into Monks. So, in offering all of this deal, Monks knew that it was guaranteed to get quite a sizable rollover, whatever happened. And the independent directors, knowing that they wanted to roll over, thought we might as well build this thing in that gives us an uplift if people want cash out. So that sort of ticks those boxes for them. All 5 of those directors are standing down. Again, this is another commendable. One of the things that constantly gets cited is this sort of bun fight as to who gets to keep the directorship positions when two things are merged. In this case, they've said, no, we're quite happy to stand down. And the management group has said, we're not going to charge any fees on the assets that are rolling over for 6 months. So that helps smooth the path of this for Monk's investment trust shareholders. Independent shareholders are going to pay slightly more in charges, but there really isn't an awful lot in it. So their ongoing charges actually was very low, because basically all they were doing was paying max order salary, and then the sort of normal running costs. But Monk's fee is tiered. So at the level that we're adding funds at, that's only going to be charged at 0.3%. And the whole thing should be wrapped up relatively quickly, I think. So the documents get published next month, and then the meeting's in October to approve that. And I think it will just sail through. And as I say, I think it is quite a good template for anybody else that wanted to get together. It obviously works better for bigger funds, but doesn't mean it's not possible for smaller funds too. And I just thought I'd put this chart up at the end here. This is 20 years worth of NAV returns. This is the what they call the ex-par NAV. So because we become fair NAVs that we always use, and all stats don't run back that far anymore. So they only go back to 2008. But this is the ex-par NAV. And actually, this ended up at the same level after 20 years. Although independent did massively outperform it for quite a long time. I think a lot of what happened here, I mean, obviously it's a stock sell-off and stock selection, but also it was quite heavily into the UK, even though it was completely free ranging. And I think that was probably a mistake, really. It should have gone overseas, and especially US, as this was going on. They should have been switching money, but it didn't happen. Anyway, we come back more or less at the same point, both of which are very credible returns over 20 years. So that's that. BioPharma Credit. So we had them on the show relatively recently. If you didn't see it, go back and have a watch. I do think this is an interesting fund. And it's got a very concentrated portfolio. It's making loans to biotech pharmaceutical companies. Those loans are secured against the revenues of an established drug or drugs. And the whole thing is designed so that there are penalties built in if the loans get repaid early. So Global Blood Therapeutics was one of the borrowers in the BioPharma Credit portfolio, and it's been taken over by Pfizer. So that triggers a repayment of the debt. So that also triggers a prepayment penalty to BioPharma Credit. So basically, they're going to get their money back, but they're also going to get $38 million in pay down, prepayment, and make whole fees. So make whole is just to give you all the interest that you would have earned had the loan not been prepaid early. And those are kind of penalty fees. So really quite chunky stuff. Adds 2.7% to the NAV. So this is what was announced this week, and it's just a quite good sort of tick in the box to show you what sort of thing that happens with them. But one thing we didn't cover when it happened, earlier on in July, there was a statement about this thing called Carthew Therapeutics. Now, when Pedro came on and talked about the fund, part of the bad news of this had already happened. But basically, going back to the end of March, they had a drug in development that was done its kind of phase 3 stuff. Everything was ready to go, and then the US Federal Drug Authority turned around, Food and Drug Authority turned around and said, no, we don't approve the drug, and its share price fell off a cliff. And you think, oh, this is a real worry, because BioPharma Credit's lending quite a lot of money. And then what we've had more recently than that, because it had already been approved in Japan. So they had a licensing agreement with Otsuka Pharmaceutical to distribute the drug in Japan. But on the back of this news, I guess, they've turned around and said, no, actually, we don't want to do this anymore. We're going to pay you $55 million to get out with this agreement that we signed with you, but no, we're not going to sell your drug. So that does, I mean, it's not completely dead in the water, but that Vedudastat, whatever it's called, is now not really sort of a revenue generating thing, which you'd think would be a huge worry for BioPharma Credit. But as I said to you at the beginning, it secures its loans on things that are approved and are generating revenue already. So they already had a drug called Auryxia. They've been running since 2014, and that plus the $55 million that's come in, plus the cash that KB has got on its balance sheet, will cover the loan payments quite handsomely. So they've agreed to let Akebia prepay 25 million, so a quarter of its loan now, and again they had to pay a penalty to do it. And then the loan will start amortizing from September, so it just falls away really quite quickly. So even though this looks like it could have been a real worry for BioPharma Credit, actually they've got the whole thing under control, and it should all turn out okay. So that's that one. And then lastly, for me, we just look at the Nelson Peltz and Trian Investors, which we've talked about before. If you remember, basically it was set up as a single asset vehicle to target Ferguson, and that's worked out all right. And under the sort of original expectation, they would have then handed the money back to investors. And hopefully would have been wound up, and in the meantime they probably would have been launching Trian Investors 2, Trian Investors 3 for other assets they wanted to invest in. But they pulled the rug on that and said, no, we want to keep going, we're not going to give you your money back, we're going to invest in other stuff. And quite a lot of investors were a bit upset about that, and that only got through by the skin of its teeth, the approval of that. And part of the objection to that happening was that the Trian, the management company, kind of voted its own shares, and also Jefferies, the broker, has a big stake, and it's voted its shares as well. So a group of dissenting shareholders got together and said, no, we're going to kick the whole board out and take control of this thing and sort it out. And actually, when you come down to it, these votes were unbelievably close. So the chairman did get kicked out, and one new director was appointed. As a chap I used to work with, actually, Robert Leggett. But that was only done on 50.7% versus 49.3% of shares voted. Everything else was defeated again. So it looks to me like one shareholder just decided to approve those first two and not the others, and it was really that finely balanced. There's a huge turnout. When most AGM resolutions, even AGM resolutions, don't get that high percentage of shares being voted. And so it definitely looks like, again, this has all happened on the back of Trian and Jefferies shares voting, which for an activist fund, and as an activist, I think this is a kind of shaming, really. And I would have thought the embarrassment factor alone would say, actually, even though we did manage to win these other things, in all conscience, we can't really keep this going. Let's do exactly what these essential shareholders want. And then if we can persuade people, we'll just launch another vehicle. That's what I would do, but we'll just kind of have to wait and see what happens next. Yeah, it should be interesting. Anyway, that's enough from me. There's the Trian chart. You can see there the price rallying since the requisition was announced. And I guess, that people will get their money back. Well, as I say, we'll see.